Assalamu alaikum everyone. Welcome back to my channel Rapid Revision. Today's video is on another question from the past papers, and this is from irrecoverable debts and provision for doubtful debts. The question here says NT started business on 1st September 2020. All sales are on credit and payment is required from customers within 25 days. On 5th May 2021, LW, a trade receivable, was declared bankrupt and a debt of 600 was written off as irrecoverable at that date. So I need to prepare a journal entry to write off the amount owed by LW, and a narrative is also required. So I'll write here irrecoverable debts debit. So irrecoverable debts account is being debited whenever we are writing off a trade receivable, that is LW in this case. I'll write here $600 and I'll write LW credit $600. On the credit side, I'll write here date will be 5th May 2021, and in the narrative I'll write to write off the amount owed by LW, to write off the amount owed by LW. So that's it for this journal entry. Then they are saying here, in addition to the irrecoverable debt of LW, other irrecoverable debts of 4100 were written off during the year ended 31st August 2021. Then they are saying trade receivables at 31st August 2021 were 91,500, and NT decided to create a provision for doubtful debts 5% of trade receivables. So interesting thing here to note is that 91,500 is an amount which is after the writing off of trade receivables. So the amount, this 91,500, it's been it's actually after the irrecoverable debts amount. So that means 4100 has been already subtracted, 600 is also already been subtracted, 91,500 is the remaining trade receivables at that last date of the year, that is 31st August 2021. So 91,500 multiplied by 5% will give us the provision amount. So 91,500 multiplied by 5% gives me 4575. This is my provision for doubtful debts amount for the year ended 31st August 2021. Then they are saying prepare an extract from NT's income statement. So there are two expenses here. I'll have to record two expenses here. So I'll write here less expenses, and this is the less expenses section which I need to make here. Less expenses, and first thing I'll write here irrecoverable debts, and irrecoverable debts will be not just 600, it will be 600 plus 4100. So I'll write here 600 plus 4100, which is going to be 4700. Then I'll write here provision for doubtful debts. I'll write here 4575, and both of these will be my expenses. So whenever we are creating provision, we record that in the expenses section. So my total expenses will be 9275 for the year ended 31st August 2021. In the next part, they are saying prepare an extract from the assets section of the NT statement of financial position at 31st August 2021. I'll draw two lines here. I'll have to record the trade receivables at end and the provision for doubtful debts. I'll write here current assets on top. I'll write here trade receivables. I'll write here 91,500. I'll write here less provision for doubtful debts. I'll have to subtract 4575 from 91,500, and then I'll get my net trade receivables. So 91,500 minus 4575 will give me 86,925. So notice that this amount 91,500 was net of all the irrecoverable debts. So whatever irrecoverable debts were written off during the year, all of them were subtracted, and then we got this amount 91,500, which was the trade receivables amount at 31st August 2021. Then they're saying here, during the financial year ended 31st August 2022, PB, a trade receivable owed 7,000, had been declared bankrupt on 17 July 2022. NT received payment of 2,500 by check in final settlement of that date. The remainder of the debt was written off as irrecoverable. So that means he owed us 7,000 and 2,500 is what he paid us. So the remaining was written off as irrecoverable debts, which will be 4,500. So I'll have to record this in the PB account. Also in the irrecoverable debts account, they are saying here other irrecoverable debts of 8,400 were written off at 31st August 2022. These are also irrecoverable debts. Then they are saying the remaining trade receivables at 31st August 2022 were 110,000 and NT decided to maintain a provision for doubtful debts of 5%. So I'll have to make the PB account first. So I'll write here uh, first September 2021, which is the next year, because before this we were doing it for the year ended 31st August 2021. Now we'll do it for the year ended 31st August 2022, which means that we are starting this year on 1st September 2021. I'll write here balance brought down. I will write here PB owed us 7,000. I'll write here 7,000. Then what he's paying us is 2,500. So I'll debit the bank account and credit the PB account. I'll write here bank. I'll write here 2,500. This is on 17th July 2022. The remainder of the debt was written off as irrecoverable. So on the same date, I'll write here irrecoverable debts. I'll write here 4,500 because that's the remainder amount, and now we don't have any balance carried down in PB account, so I'll balance this at 7,000 on both sides. In the next account, that is the irrecoverable debts account, I'll write here PB, I'll write here 4,500. Then I have other trade receivables also which I have to write off, which is 8,400. So I'll write here trade receivables because I don't know the name of specific trade receivables. So I'll write here trade receivables. I'll write here 8,400, and this will also be on 31st August 2022. So I'll write here these were also written off 31st August 2022. These were written off on 31st August 2022, and this thing is also on 17th July 2022. And then both of this will be transferred to the income statement. So 4,500 plus 8,400 is 8,400 plus 4,500 is 12,900. I'll write here income statement. I'll write here 12,900. This will also be 31st August 2022. And then this account will balance at 12,900 on both sides. Irrecoverable debts for this year, that is for the year ended 31st August 2022, is 12,900. Then I need to make the provision for doubtful debts account, which is easy. What they are telling you is that the remaining trade receivables at 31st August 2022 were 110,000, which means that 110,000 is that amount from which all the trade receivables that we have written off has been subtracted already. So we have 110,000 as the remaining trade receivables. We have to multiply this by 5%. So we'll get 5,500 most probably. So 110,000 multiplied by 5% gives me 5,500. Yes. And then last year's provision for doubtful debts was 4,575. So I'll start with the balance brought down. I'll write here 1st August 2000, 1st September 2021. 1st September 2021 is the starting date. I'll write here balance brought down. I'll write here 4,575, and my latest provision is 5,500. So 5,500 minus 4,575 will give me 925, by which the amount of provision for doubtful debts will increase. I'll write here income statement. I'll write here 925. This will be 31st August 2022, which is the ending date of this year, the last date of this year. Then my balance carried down here will be 5,500. I'll write here balance carried down. I'll write here 5,500. I'll write here 31st August 2022. And this account will balance total at 5,500 on both sides. This balance carried down will become your balance brought down. I'll write here 5,500. This will be 1st September 2022, which will be the starting date of the next year. And then they're saying here, this is interesting because this is another question. This is basically theory, but you need to analyze two options in this case. They're saying NT is concerned at the increase in irrecoverable debts during the second year of business. To reduce irrecoverable debts, he's planning to introduce one of the following two options. One is to charge interest on all debts not paid within his standard terms of payment of 25 days. So if the customers don't pay us within 25 days, we'll charge them an amount of interest on their outstanding balance. The second option here is to stop supplies to all customers who do not pay within his standard terms of payment, that is 25 days. So I've written the answer for you guys here. So what I have to do is that for option one, I need to write an advantage and disadvantage, and for option 2 also I need to write an advantage and a disadvantage, and then I give my recommendation. So here I'm saying if NT charges interest on overdue accounts, this will damage the relationship with customers. Customers may go to competitors who may offer better terms. So competitors who are not charging interest on overdue accounts, they may go to those businesses, right? Because the customers also want convenient payment terms. Then they're saying here the benefit of charging interest would be that the income from interest will increase, and therefore the profit will increase because of the income that you're receiving from interest. Then you need to analyze the second option here. If NT stops supplies to customers who do not pay within his standard terms of payment of 25 days, customers may again find other suppliers who offer better credit terms. Again, because there are lots of other competitors who give more time to customers to pay. So customers just may find other competitors from whom they can buy those goods also, and then this may also damage the relationship with customers. However, because of this, customers may pay us in the 25 days time period, which is a good thing, because this will actually give them an incentive to pay within 25 days. Also, this will reduce our possibility of irrecoverable debt because we are stopping supplies to them. And if we stop supplies to them, if they don't pay in 25 days, then this will actually act as uh, this will actually encourage them to pay on time. And then the last thing here is the recommendation. So I think that they should stop supplies to customers who don't pay within 25 days. That is it for this question. Thank you so much for watching.